Recording. So, welcome everybody. This is one of our last April classes. This is awesome. We have Rusty Schatz from Davidson here with us today, and he is going to be doing retirement now what. I've been looking forward to this class because I have questions too, but I am Karen Ritchell from University of Idaho Extension, and I am just pleased to turn everything right over to Rusty and let him start talking about retirement and now what do we do at this stage. So Rusty, take it away.
All right. Well, welcome everyone. Thanks for having me. And hopefully I took this in the right direction here based on what Karen had asked me. Regardless, if there are some questions that I don't answer, don't hesitate to ask those questions at the end, or feel free to type those in the chat box, and I'd be happy to cover those. I'm dealing a lot with all the craziness that we're experiencing here with COVID-19 and how it's affected the market, how it's affected our personal lives, as well as potentially retirement planning and plans. I have quite a few clients that are either near retirement or have just retired, and this definitely impacts those clients. So it has been interesting seeing how every aspect of our lives have been affected, and working from home. We have 4 of us in our office here, and we can't be in the office at the same time with everything. So we juggle, and I get about 3 hours a day in the office and then try to work from home. And like many people, all my children are home from school, so it gets really interesting trying to keep things quiet. And I chose to do the Zoom meeting in my office at work, so I didn't have a 3-year-old or a 5-year-old running in and talking to me. So as Karen mentioned, I work for Davidson. I'm a senior vice president, financial advisor, portfolio manager. So I help people with retirement planning, and I manage the actual investments for most of my clients as well. Of course, a fair amount of what we're going to be talking about today will be focusing on the investment side, but hopefully covering a fairly broad area as well, dealing with retirement and how this has impacted people's retirement. So there will be three areas that I focus on. Number one, what are some of the financial effects of the virus, and how should we react in regards to our investments? And I will be looking at the financial side, definitely not the medical side. I'm not a medical professional and won't pretend to be. Number two, what can we hope for in the future in regards to investing in the market? And number three, what you can do now to plan for the future. And just a little bit of a disclaimer, and you can of course see the disclosures, the legal language there that I have to put on the slide. But a disclaimer that this is general information geared toward a fairly wide audience. And to discuss your specific situation, I'm always happy to do a one-on-one call. I know Karen does a lot of that. She's happy to answer those one-on-one questions as well, or your personal financial advisor or whatever. But this is obviously general information dealing with a wide audience. So first, and go back one, Karen, for a minute. Just a word to anyone looking at retiring now or in the next few years. Imagine for a moment that you've got a blank piece of paper and you draw 2 circles that are overlapping just a little bit. One of those circles represent the things that matter in life, and the other circle represents the things that you can control. What we're hopefully dealing with is that little tiny area that overlaps the things that matter that we can actually control. There is so much out there that we have no control over. Even if it matters, we have no control, and so we can't necessarily change it. And so we should focus on the things that really do matter, that we have control over. And one of the things I look at during this time is the nightly news. With the advent of smartphones, I call it nightly news. With the advent of smartphones, I check my news at 5 o'clock in the morning when I get up, and I probably check it 30 or 40 times during the day. and I could easily drive myself crazy looking at the news and how it might impact my life, most of which I have no control over. There's nothing that can change. And so sometimes I'm using up neurons or whatever's going on in my brain. I'm worrying about those things that I really don't have control over. We as humans like routine. We don't like knowing, or we do like knowing what the future holds for us. Retirement is one of those things that can cause a lot of apprehension, not knowing where a paycheck is going to come from, not knowing, what Social Security might look like in 10, 15, 20 years, not knowing what our investments might do, et cetera. It makes us nervous. Having a job and having routine gives us comfort sometimes, irregardless of the paycheck, just knowing that we have a steady routine day to day. And so when that routine goes away, obviously our comfort level goes down, and we become a little bit more nervous. And sometimes we make decisions because we're not comfortable. We don't have that routine. I remember kind of give my age here. My 3-year-old said I was really old yesterday, and whether or not that's true, you can determine here. I graduated from college here at the U of I in 2001. I was a fall graduate, and so when 9/11 happened, the planes crashed into the towers. I'm sure most of you remember where you were. I was walking on my way to class that morning when I heard the news, and it's something that none of us will ever forget. In very different ways, but in certain ways similar, we're experiencing a shock to the markets, a shock to our way of life, all of those things with this coronavirus. There isn't a person in the US that could say that they're truly not affected by what has happened. And obviously 9/11 was something that none of us would have predicted. This virus, potentially there might be a few people that out there that could say they predicted something, but really for the most part, it caught everyone by surprise. And we'll talk a little bit more about that as we go on. And so when we face uncertainty, when we get rid of our routine, all of those things, how do we even think about making a big change like retirement? It's really tough. And what I encourage people to do is take the 30,000 foot view. If any of you have ever used Google Earth, one of my favorite things online, you can zoom out and see different places that maybe we've gone hiking, different places that we want to go, whatever the case is, and you can zoom out and see the bigger picture. Most of us don't retire for a year or 5 years or even 10 years. Hopefully most of us retire for 20 or 30 years. And so we do need to take that bigger view. In terms of 30 years, this really is just a blip in time. And so we need to kind of put that in perspective and get out of the weeds. That doesn't mean that we don't have to look at the nuts and bolts and kind of do our safety check before we embark on our adventure. Nuts and bolts in this case, to me, simply put, would be what are our expenses during retirement and what is our income? And that would be a conversation that we could spend hours on, really. But for any of you that are approaching retirement or just into it, it really makes sense, in my opinion, to sit down and look at your fixed expenses, your variable expenses. So those fixed expenses are going to be the things that are occurring every month in and month out. Variable expenses are going to be those things that happen a little more irregularly, something that you pay annually, something that vacations, tires on the car, etc. Tricia, I see your comment there, and we're actually going to get to that in just a bit. So hold that thought, and if I don't cover it by the end, remind me. But we'll talk a little more specifically. Income, of course, Social Security is brought up a lot, and there's lots of concern over any sources of income right now with everything going on with the government, et cetera, and all of the payments going out, and really lack of of tax receipts and all that as well. So we definitely need to look at what is guaranteed income, and then what is variable income from investments. And I won't spend too much time in this talk discussing it, but when we're talking about investment income, I'm not talking about speculating in the market. I'm really talking about creating an income stream that will last a lifetime, that will compete with inflation, and that will be certain good times and bad. We've seen dividend cuts this year, so in the last, say, 2 months, than we've seen in the last 10 years combined. And so, again, not going too deep here, but it really is important when we're looking at investments that we invest in high quality companies, funds, etc., that we have a proper allocation, all of that, to make sure that our investments hold up well during bad times. So let's go ahead and go to my point number 1 here: financial effects of the virus and how should we react. And a couple of reminders here. First, everyone's situation is different. And here are a few questions that each of you could consider how your situation might be different. How were your investments set up before this crisis? There were people that were super aggressive. There were people that were conservative. There, lots of different variations there. And the people that were super conservative have held up very, very well. Some people that thought they weren't that aggressive found out, really how they were allocated when the market dropped. How close are you to retirement? How much income do you need from your investments? How much volatility can you handle emotionally? Again, that's one of those things that we really found out. Do you have an emergency fund? And I talk about that quite a bit here and remind people, if we don't have an emergency fund, that's something that we need to start working on. It doesn't mean that we put it away all at one time. When I say an emergency fund, what I'm talking about there is, say, 3 to 6 months of average spending put away in a savings account or something that's safe that you can access for times like now. Just a quick thought with that. When I look at companies to invest in, I look at the very same things that I would look at on the personal level to make sure that you were situated well and ready to handle the future. In other words, do you have sufficient cash flow on a monthly basis? Do you have enough cash set aside to provide for a rainy day? Does your income look all right? Are your debts low, et cetera? And there was a client that wanted to invest in a certain type of company that this industry really dropped with the coronavirus, everything going on, because people weren't visiting this type of retail store, call it. And he gave me 3 different companies that he wanted to invest in mid-March. And I looked at them, and one was heads and shoulders above the other 2 in terms of cash flow, in terms of cash on hand, kind of the emergency fund theme. And I just looked at it this morning to see how we had done going back when we had bought the one company that we went with. And there was over a 25% difference in return in less than a month between those 3 companies, because the one did the right things along the way so they could hold up during the downturn. A few more questions. If you sell now, will you rebuy? And if you will, at what point? People tell me, I want to get out of the market and I'll get back in when things are better. What exactly does that mean to you? Are you diversified? And what does diversification mean to you? The questions are endless, and I won't keep going on that, but it's good to ask ourselves questions, and that really gets into this next slide. So as everyone knows, and this will prove I'm not a doctor, we have 2 sides of our brain, and I'm going to really simplify it here. I'm going to call one the thinking side, so what is logical, and then the emotional side, what I'd call the side that deals with panic, with enjoyment. During times like the last month, we've experienced kind of the fight or flight side of our brain. And think about these two sides. When one side heats up, the other cools down. And so cools down means it's not working, it's not doing much, and heats up means it's really working. And so when we hear that all the toilet paper in the stores is disappearing, that emotional side heats up, and we panic and rush out to buy as much as we can. Now, don't come to my house for some or anything, but right before this happened, we happened to make a Costco trip, and life was good on the side of toilet paper. But I can tell you, with everything going on, every time I go to the grocery store, I look down the toilet paper aisle and see if there's toilet paper, because inside that side of my brain, I want to buy some more toilet paper just to make sure that we have enough. And that's just the way that side that side of our brain works. When the market early March was dropping 3,000 points in a day, again, that fight or flight instinct kicks in, and we want to sell all of our investments. We want to be safe, regardless of what the thinking side of our brain might say, regardless of what the long-term consequences for our retirement plan might be. The emotional side says, this is what you've got to do. You've got to be safe. And so how do we cool that side down and get the other side heated up a little bit to really think through the process? Now, the right thing to do might be to sell some things, might be to buy some toilet paper, etc. But we've got to think through it and not just let the emotional side work. And so the way that we get the other side working is by asking ourselves some questions to force that side to start working. So we start asking ourselves, for example, what would be the long-term effect on my portfolio if I sell when the market's down 30%? If I have a plan for retirement, do I have it written down? Start working through that, write some goals for retirement. What does my retirement plan say in terms of how I should be invested, and how does that compare to the way I'm invested now? And so again, it takes you to the thinking process rather than just the emotional side. Will my emergency fund carry me through a prolonged downturn? With some of my clients, when the panic was going on during early March, we would have these conversations, and we would start asking questions. We say, okay, you're a 60-40 allocation, 60% stocks, 40% bonds. And oh, by the way, we sold 10% of your stocks early on. Things started getting a little bit rough. So really you have 50% of your portfolio that hasn't moved much, if at all. And then we take that 50% and convert it to dollars and say, how soon would you need that kind of cash? And the answer usually is several years before they would ever use up that amount. And so then they can start thinking about the idea that they don't need to sell the stock side, because they have 5 years plus of either cash or fixed income to be able to hold up during the downturn. So you get the idea there. So a few statistics to talk about the market here just a little bit. And Karen, you can go ahead and skip to the next slide there. We went from an unemployment rate at the end of January. I'm sure you all remember back to January, and things were pretty good back then. Our unemployment rate was 3.7% plus or minus, to one now, if I had to guess, of around 14%, maybe 16%. Numbers come out every week, and they're not pretty. Everyday life has been altered for many Americans. Many that are living paycheck to paycheck are out of jobs, starting to miss mortgage or rent payments, concerned about feeding their families, and even worried about health and survival. Let's see, Karen, can you go ahead and advance the slide there? One more, keep going. Right there, okay. So this is a chart showing the Dow Jones Industrial Average, and I just use it because most of us are most familiar with the numbers. going back to November 4th of 19 through the 23rd of this year, 23rd of April of this year. And we hit a high on the Dow on February 12th of this year of 29,951. So we almost got to 30,000. And a few short weeks later, on March 23rd, we hit our low of 18,592. That was a drop of 38% at its worst on the Dow. The S&P wasn't down quite as much, and the NASDAQ wasn't anywhere close. We can talk about that if anyone would like. At current value as of yesterday of 24,133, we're up about 29% from the bottom. And so we hit a new record for the fastest drop to 20% in history, taking about 6 days to drop 20%. It was if any of you followed the market in early March, we didn't hit 2 positive days in a row for pretty close to a month, I believe, if I remember right. So it was a bit scary. As a positive note, as of at least 422 here, my numbers are a couple days old. The S&P stands 26% higher than the low just 4 weeks ago. So we're down about year to date, about 18% on the Dow, about 13% on the S&P. We're down only about 4%, call it, on the NASDAQ. And the NASDAQ has a lot more technology. And as you can all guess, using Zoom here today, and things like Zoom technology has held up pretty well during this downturn, which isn't always the case with downturns. So I talk to clients a lot about the market usually turning positive. As again, as a reminder, we're up over 26% from the lows. Markets will always turn positive before the news will. So you will continue to read negative, negative, negative while the market has already rebounded to some extent. That doesn't mean it will keep going up. There are different shapes of recessions or downturns in the market. There's what we call the V-shaped recession. And looking at the bottom of this chart that you can see on the yellow line there represents the market, the Dow. You can see a pretty good V there. There's a U-shaped recession, and there's also one they're talking about being a potential of a W-shaped recession. So that could happen. We really don't know at this point. We'll see what a lot of it depends on how quickly and how safely, I'll throw both of those out there together, the economy can begin to open up throughout the summer. So really we'll just see what happens here and how things open up. All right, so our next point is what we can hope for in the future by looking back. And one of the, I'll mention this a couple of times, but one of the most dangerous phrases, especially in the market, that we can say or listen to is, "This time it's different." And I hear that a lot. I heard that during the 2008 downturn, definitely during 2001, 9/11 and all of that, the dot-com crash. When we hear that, while the causes are maybe different, the way that people react in crises, in downturns, in panic mode are very similar time and time and time again. That doesn't mean we'll drop exactly the same amount or we'll come back as quickly, et cetera. But panic is panic. And one of the wonderful things about the people in the US in general is we forget quickly. We forget negative things and we move on and we get excited about life again, and we're ready to go out and live our lives and be happy. And Kara and I, a shout out to you. I love the name of these classes, Happy Classes, because I am an optimist. I look forward, and whether it's maybe the next months will continue to be tough. But as we look out a year, 2 years, 5 years down the road, life is good and we're going to be okay and we're going to get through this. So an analyst brought this up the other day in a call that I really liked. When we start to get down and we look back at some of the different viruses that we've had going back over time and think, what possibly could go wrong? How horrible could this get? This analyst reminded us of some of the technological advances that we've experienced in recent years. He brought up the iPhone. I don't know how many, I can't obviously here get a raise of hands, but how many of us have or have family members that have an iPhone? And I won't tell you the number that we have in our family, but we're strong believers in the iPhone, and I think they're on the 11th version now. They've been around about 11 years, plus or minus. And I remember when I got my first iPhone, and it was, I resisted as long as I could and tried to keep the flip phone, but I finally caved and have never looked back. And it's amazing. We look at weather on our iPhones. We look at the market. Again, 5 o'clock in the morning, I'm looking at news. I'm looking at all of the stock market futures. I'm looking at the individual company information. We're checking our email. We're checking our text. Zoom, if some of you might be on Zoom on your iPhone today. And so, and I pick on iPhone, but we could throw, Samsung or whatever version out there. It's amazing how far we've come. Think back to flight. Think back to the Wright brothers and all that they had to go through to be able to have that first plane leave the ground. And think of Boeing or Airbus or whoever, and now what they go through if they want to create a new plane that will fly 200 or 300 people. And yes, we've had some horrible things happen with crashes in the last few years. But if they want to create a new plane, they design it online, on the computers, and then the pilot gets in it and he takes off once that first one's built. And I don't think most of those pilots are too worried that it's going to fly because of everything online that they have the ability to create and test and all of those things. So we think back to there have been several flus that we've dealt with, and I say flu, viruses, I guess we could say, the Ebola and SARS and all of these things. And I hear of those, but the numbers in no way compared to what we're experiencing today. And so I kind of dismiss those and say, yeah, but those really can't compare. And so we have to go clear back to the flu of 1918 to really get the numbers and all of that we're experiencing today. And with the Spanish flu of 1918, for those of you that weren't around, I definitely wasn't. We had 5 million deaths worldwide, about 675,000 deaths. And of course, remembering 1918, right around World War I, and very contagious, get into soldiers' barracks and things and wreak havoc. And remember or imagine the technology that we had at that point versus what we have now. Advil, any guesses when that was invented? 1961. So you can imagine just simple old Advil and all the drugs that have come since. The virus that we're dealing with now, they put it up on a computer. They can draw it out, can look for weaknesses, all of these things. Johnson & Johnson, to name one company that is creating vaccines for this. They're still just starting into the testing phase. They don't know if it will work or not, but they're making millions of doses in hopes that it will work based on all of their computer generated assumptions and everything. So it's definitely a different world. So I truly believe that we are in a different world now than we were back then, and that now relative terms, it will take a while to get, vaccines created, antiviruses created, et cetera, but it will happen. I'm certain of that looking forward, and things will improve. Trish, I just saw your note there. What do terms fixed income and guaranteed mean as asset classes? So fixed income would be things such as CDs, bonds, cash, treasuries, things like that. Guaranteed typically is going to mean either treasuries or I also used it earlier representing Social Security. So typically guaranteed would be something guaranteed by the federal government. In my world, we're very careful how we use the word guaranteed. If it's guaranteed by a company during times like this, that doesn't mean much. If it's guaranteed by the federal government, hopefully that means something, and that they would typically pay. During 2008, 2009, one thing that we typically referred to as guaranteed as FDIC insurance. And we had quite a few banks fail during that time. And every one of those that was FDIC insured, paid off and reimbursed losses and everything. So hopefully that answers that question. Karen, let's go ahead and skip to the next slide. This chart is just a history of the US bear and bull markets going back since 1926, I believe. It's kind of small on my screen if I can read that right. And I love this chart. So the blue represents the bull markets, again, from anything that when the market hits the bottom that grows at least 20%. And then the orange below the line represents bear markets. So again, when the market drops 20%, usually accompanying a recession, but not necessarily always the case. And I just remind people that, when they panic and worry about everything going on right now, just look at this chart and ask yourself, which team would I rather play for, the blue team or the orange team? And to me, it's pretty easy to see that, I'd much rather be invested with the blue team. The market is up around 70% of the time. It's down about 30%. Yes, we should have some diversification, some, an asset allocation, meaning how we're invested in some mix between stocks and bonds for most people. You have to have a pretty brave stance to be able to withhold dropping 38% in a year like this and staying the course and not doing something that you'll regret. Because if you're invested, say, half and half in a balanced portfolio, and you dropped half as far as the market, but you stayed invested, that's much better than being all in and then panicking at the bottom and pulling your money out. So hopefully that makes sense. All right, bear with me here. Have to glance at my notes. Karen, go ahead and jump to the next slide. And so the next two charts, and you're not expected, I think I shared this as one of the handouts. You're not expected to read all of these things, but everything that's written on here is negative news that has impacted the market. And this goes back to, I think, beginning of 08. And there have been a lot of things. And I call this my wall of worry chart. So the market continues to climb a wall of worry because there always is negative information. And if we jumped out of the market every time negative information comes, we would never be in the market, and it would cause us to make a lot of decisions that would hurt our long-term investment plans, our long-term retirement. So most of us know someone that's a constant worrier. I'm sure if we were in person and asked people to raise their hands, I'll bet we would get a third of those involved here with the class would probably raise our hands. That's just life. But they're, again, referring to those two circles that we talked about at the beginning. There are things that matter and things we have control over, and we'll save ourselves a lot of headache and heartache if we don't, or if we try to not worry about the things that we can't control. Okay, Karen, go ahead and skip to the next one. And this is just a little different way of looking at it, a lot bigger things spread over a longer period of time. So going back to 1929. And this represents GDP, not the market, although they're fairly similar. Again, since the Great Depression, and you can see all the wars on there. You can see lots of really big negative things. And in spite of all those things, GDP, gross domestic product in the US, how much we produce as a country, has continued to improve and do well over time. Let's go ahead and go to the next slide here. So we learned something in college in business management was my major, and in my economics classes we learned something called linear regression. And basically what it says is you look at historical charts to predict the future, and that works great. But often what we do is shorten that history down to a very short time frame. Kind of like a couple in marital counseling, for example, that throws out the words "you always" or "you never" or whatever, and everyone gets worked up and offended. And it's kind of like that, where we shorten this time frame, and and we say the market always goes down or the market always goes up or whatever, and we've got to get rid of that vocabulary. And again, kind of like the Google Earth example that I shared early on, we've got to zoom out and take that 30,000 foot view and say, what has the market done over the long term? Forget about these, what President Obama called at one point during his early presidency as the short-term gyrations in the market. You've got to ignore those as much as possible. I know it's hard, and stretch that out. So this is the same chart we used earlier here, but I imposed on it, the always go down the red or pink line there, or always go up the yellow straight line there on the right. And we've got to ignore those and instead focus on the blue line, which represents the long-term averages of the market, that it goes up over time, say 8 to 10% average annually. And the blue dotted lines outside of the main blue line, those represent what I'd call one standard deviation outside of the market, that most of the time it fluctuates within that sphere, call it. And beyond that, we have times like right now. And we're going to talk a little bit more about that. So go ahead and skip to the next one if you would, Karen. All right, so we hear a lot out there, and I heard this in 08 too, but we're now experiencing what we call the new normal. And the following two slides will discuss that just a little bit. So everything's going to change. We'll probably never shake hands again with anyone. We'll probably never go without our face mask. We could throw lots of things out. One of the most dangerous terms we hear is "this time it's different." And again, not in terms of specific causes, but in terms of financial effects. So let's look back at history a little bit and see where we are now. Okay, Karen, go ahead. All right, so this chart is kind of fun. This comes from one of the handouts, the Should I Sell My Stocks Now, I believe it's called. And this chart shows, going back since 1970, each year how much the market dropped from its high during the year, how much it dropped down at any point during that year. And so the average market drawdown, as they call it, has been 15.7% during that time. So in any given year, the market has dropped 15.7%, which is about where we are right now if we looked at, just where we stand right at this moment. Obviously, we've dropped. We're down in the 30s, so we're one of those bigger lines here. If this was up to date, this is just through the end of last year, but it gives you every year we have some volatility. Every year, we're going to drop at some point, and it scares us, and we question things. All right, Karen, go ahead and jump to the next one. All right, and this one, I apologize for it being fairly small. I'll just go over what it says in case you can't read it there. I had a hard time making it bigger and still capturing everything. So again, remembering that thing that says "this time it's different." So this shows the different amounts of decline, we'll call them, on the left-hand side. and we'll just talk about the S&P 500 here. So the different amounts of decline, how often it happens, how long it typically lasts, and the last time it happened. And this was again based on year end of 2019. So the last time before this that we experienced a 5% drop was April of 2019, and it lasted 24 days, and it typically happens about 5 times a year that the market drops 5% or more. 10% about every 7 months, and December of 18, anyone remember that? That was a little bit rough. I remember Christmas Eve coming in, and usually Christmas Eve is pretty calm, and we had a 700 or 800 point drop that day. 15% or more, again, December of 2018. And the market actually dropped about 19.6%. So we didn't quite hit the 20%, but we were really, really close. And 20% or more was clear back to March 09, and that typically occurs every 2.5 years. And so looking back, you know, that's over 10 years now that we haven't had a 20% drop. We hit one in 19% in 2011 and then 2018, as I said, but didn't quite hit that 20% drop. So it's kind of like if you've ever been driving on a highway, say early fall, and it hasn't rained for 30 or 40 days, and all of a sudden it rains, and everyone is sliding off the road, running off the road, forgets how to drive, or the first snowstorm you could throw in there as well. And we all forget what it feels like after we've had a period of calm. And that's really in the market a little bit of what we've experienced here. So, so I guess what are the takeaways in regards to our investments? First of all, initially make sure you're not taking too much risk when you first set up your investments for retirement. And some of you might say, oh, too late, we already did that. We set it up, we thought it was safe, and now we see that we've dropped. Now, most of the time, and again, this is something that you need to talk about specifically in your situation, but many times the very best thing we can do is take our hands, put them underneath of us, and sit on them and do nothing, because sometimes the worst thing we can do is selling when things are way down. That doesn't mean that we analyze, you know, the holdings, or have someone that does that for us, analyze those holdings and make sure they're the right places to be, but don't panic and pull out and then lock in losses. When we're in retirement, we should be focusing on income and not accumulation. So in other words, focus more on securities that pay income and not so much worried about growth necessarily. Once you are invested, don't make big changes due to emotion. You've all heard the old adage of buy low, sell high. That's simple, but it's not necessarily easy. When you're considering making an emotional decision that could lower long-term returns of your investments, think of the brain analogy I shared earlier. Talk to a professional, get your thinking side of the brain working, and really think through it before you do something that you might regret. And as I mentioned earlier, think about the companies that you're invested in, how solid those are, what their cash levels are, et cetera, et cetera. That's a lot of what you know, we spend, guys and girls, ladies, in my world, what we spend our time doing. Go ahead, Karen, and skip to the next slide here. All right, so the final point here as we're winding down is what can you do now to prepare for the future? And just referring to the slide here, first of all, be prepared. Going back to that emergency fund, that is so key. I can't tell you what a difference that makes. I hear story after story after story of people living paycheck to paycheck and already not being able to pay their home mortgage, their rent, car payments, etc. So do everything you can to work to build up that emergency fund, even if it's slowly over time. Try to get debt paid off. We don't need the newest and greatest car, you know, whatever it may be. Having that debt paid off is so worth it for the peace of mind that it brings. always encourage people to live within our means. And I, like everyone else, like to buy things, but it's not worth the stress when we can't make our payments. And then the last item I put there is budget, and I put whatever it means for you, because Karen has taught enough budget classes. I'm sure she'd concur with me that budgeting is hard. Budgeting is boring. Budgeting, it's could almost be a 4-letter word for lots of people. I am an avid budgeter. I've budgeted since we were going through college, and it has been a lifesaver for me. I love budgeting, but it is hard for people, and it's not fun, not exciting, et cetera, et cetera. So there are many different versions of budgeting, but find what works for you, but make sure that you're spending less than you're earning, and life is pretty good. And so setting up whatever controls you need to make that happen. Have faith in the future. Look out, be positive. I find that investors that are positive, are optimistic for the future, typically do better in the market. And that sounds weird, but it's I swear optimism goes with that. Plan to succeed. Just making sure that you have a plan in place, and then that you are following that plan so you can be successful. Lots of us put together a plan, but we never refer back to it. I ask people what is in their will, what is in their retirement plan. Most people can't say, because we don't look at it often enough. It's that roadmap that we don't follow and we get lost. And the last one there is do better next time. And what I mean by that is we all make mistakes. We all do stupid stuff. I sell things when I shouldn't, because I get emotional too. Especially when it comes to my own investments. I can look at that, I can learn from it, and I can say, okay, I'm going to put things in place so that I do better next time, and we'll be able to still reach my goals and retire how I want to. All right, last slide here, and we're running short on time, I know. Okay. This is just a slide that I added just because some people will have questions on it, and it's information that we definitely want to get out there. The CARES Act is the recent act passed by Congress. Most of you know the one part of it that deals with your $1,200 stimulus payments that some of you may have gotten, some of you may not have. Here, both sides of that. So that's one big part of it. Cash payments to eligible individuals based on income, number of children at home, etc. Retirement provisions, just go quickly through these. Penalty-free distributions from retirement accounts for qualified individuals, and those are fairly specific. So if you're under age 59 and a half, normally you'd have a penalty for pulling out of an IRA, etc. If you meet the qualifications, then you can possibly get those waived, but don't just assume you can go pull money out and that it will be automatically waived. It increased 401k loan limits. I do want to offer a caveat there as well, that if you already have a loan and your 401k only allows for one loan at a time, you're kind of out of luck, because you can't get a new one until that one's paid off. So it doesn't mean that that's just free and available. And then finally, this impacts lots and lots of my clients. The required minimum distributions for those now over age 72, with a law passed last fall, it moved from 70 and a half to 72 when you have to start taking that. That has been waived for 2020, much like it was in 2009 when the market was down. As well, most of you are aware that the tax filing dates have been postponed. A little bit of a caveat there as well, that I've seen it where people have to make estimated tax payments for the next year. So normally those are due, one in April and then one in June, I think, June 15th. So now that first one is postponed out to July 15th when taxes are due, but you still may have to make that second payment that was due in June by June. So in essence, you're still going to have to make that estimated tax payment by June. And you can refer or talk to a tax professional on that to get more specifics. And then finally, you can deduct up to $300 of charitable donations without itemizing. And so most people the last couple of years with tax law changes, if you didn't itemize, basically the only way you could give to charity if you were under the exempt or deduction limits was to give through like a required minimum distribution or something like that. So I did include a handout for that as well. All right, so let's see what questions that we have typed up here, and I'll answer those. And then I think Karen said she was going to open the lines up as well for vocal questions. Let's see. The question was asked if we can give a history, a copy of the slide, a history of market corrections. And if I didn't include that, I'll email a copy to Karen and she can get that out to you as well.
Yep, we can definitely do that. I can send that out for you. And if you're muted, if you've muted yourself, you'll have to unmute yourself. I've unmuted everybody so you can ask your questions.
And another question was, is it possible to provide us with an example of a retirement plan? I'm not sure what all that should include, and that absolutely, you know, we in the business do some pretty fancy ones that are 30 or 40 or 50 pages long and go into all kinds of aspects of it. It can be as involved as that, or as simple as a one-page, you know, lined page with income, expenses, set up to show how much you're going to pull, how expenses are going to be covered, etc. Karen, do you have any examples?
I actually have one from college that was an assignment that I did that is pretty fancy, and I would be glad to share that with folks. It is pretty fancy, but the thing about retirement plans is they're very individualized. So it's not like a will that you could get from an attorney that it would be a sample will that you could see a retirement plan, because each person is going to be very, very individualized according to what their retirement needs are. So I'm more than happy to share what I did with, it was actually a major assignment that I had in college, and it turned out really, really good. So if you're interested in seeing that, just send me an email and I'll be glad to share that with you.
Thank you, Karen.
I'll send it your way too, Rusty. You can critique me.
Well, sounds awesome, and I would agree in that everyone is specific. I meet with a fair amount of young individuals helping with setting up a budget, and I've got my budget that, like I said, I started in college. And it's a spreadsheet that I have these all kinds of formulas and everything else in it. It's I guess fancy for me, and it wouldn't work for anyone else because it's very specific for me. But I still encourage everyone to do a budget, and you just have to find what works for you, and really sit down and make sure that you're putting the most important aspects of income, expenses, all of those things, and figuring out how those will be covered, combating inflation, all of those things throughout your retirement years. So another question, what IRS form is for charitable donations? And I do not deal with tax, I apologize. So you could Google that or consult with a tax person on the charitable donations. And I would bet with this CARES Act, anything dealing specifically with the changes in the law, they're probably still being updated. They might be updated by now, but you know, some of those would even in, say, TurboTax or with an accountant, you know, they'll still have to be updated. Of course, those won't apply until you're doing your taxes for next year anyway, so next spring, but you know, definitely won't be updated yet. And then is the next question, is the CARE cash payment taxable? It's actually a tax credit that is applicable on next year's taxes. So you're basically getting this tax credit early. And so I guess not being a tax professional there, in a certain way, it kind of is. You're going to be noting it on your taxes next year, but it's considered a credit. So kind of yes and no. it will impact them slightly, but it's not considered taxable as like ordinary income would be.
And so,
Hopefully that-
Rusty, with that CARES credit, if people have not received their CARES credit yet, if they haven't received their CARES credit yet, the direct deposits have already gone through, but the ones that actually mailed in their checks or their tax returns, they will actually get their CARES check later. So,
and you can find out where your specifically stands by going to Find My Payment. Just type in Find My Payment in Google and go to make sure and click on something that says IRS on it. Don't be careful. Yeah. But as long as it says irs.gov on the website, and then there's a thing in there that you can actually still put in some information to figure out where it's at, et cetera. And if you qualify.
Yep, there's one for the stimulus check, and then there's also one for your tax return. So if you haven't received your tax returns back yet, the federal tax returns are being really slow and coming back. So just be checking on those and making sure that you're staying on top of all of them. So, but definitely go to irs.gov. That is the IRS's website, and those are secure links that you can go and check those things out, as well as the charitable donations part. They have wonderful publications and resources in there that will tell you exactly what charitable donations actually are.
A couple of more questions. Someone, or a statement here, someone said they checked on the IRS website and there's no info for them. That's what mine is showing. Talked to someone yesterday and his was showing that he got with his accountant, and his accountant looked it up and found that the bank account info was wrong on his for some weird reason, because he had been getting direct deposit for years. So, you know, there will be some strange things. I would continue to check on it, check on the upper limits of income and make sure that you qualify. First of all, if you don't qualify, it will just say, you know, it can't be determined or something like that. So, but definitely, you know, if you haven't gotten it, go to the IRS website and do just a little bit of research. It doesn't, they've got a fairly good amount of information there.
So I just hopped online, Rusty, and what it is when you go on to IRS's home site, so it's irs.gov, it says get coronavirus tax relief. It's the second box on the left. If you click on that, then click on your payment status. You have to scroll down just a little bit, but it says get my payment. And then what you do here is it tells you what you need to do or what you haven't done, and you just keep clicking on the boxes until it gets you to okay. It gets you to, you put your social security number, your date of birth, your street address, and your zip code. You continue in there, and it will tell you when you are actually getting your refund. You want to make sure that you do log out of that system though, because this is a very hackable site. So you want to make sure that somebody doesn't get in there when you're done.
Very good, thank you. And another question came in, and I did not answer this yet. Should we give our portfolios at least 5 years to recover? I was going with the easier to answer question first, and then jumping back to this. Should we give our portfolios at least 5 years to recover? It really depends on the individual portfolio. I hope not. I hope we're nowhere near 5 years for most balanced portfolios. As I mentioned, the NASDAQ is down 3.8% right now, year to date. Dow and S&P are down, of course, in the teens. I'm hoping that we recover considerably faster than that, but there are some unknowns. And that's really where I focus with retirees, more on income. To give an example, as I mentioned, that there have been more dividend cuts during the last couple of months than there have been in the last 10 years combined. I focus a lot with retirees because we're focusing on income during retirement. I focus on owning what are called dividend achiever companies or dividend aristocrats, meaning they've paid and raised their dividends for a certain number of consecutive years. So a dividend achiever is 10 plus years. An aristocrat is 25 years, that every year they've paid and raised their dividend. And so you can imagine with a track history like that, they're going to want to continue doing that. As of 3 days ago, I believe, not a single dividend aristocrat had mentioned. We've had lots of companies cut dividends. So when we're focused on getting a steady income stream from these type of companies, as well as our fixed income portion of our portfolio, we're not so concerned with the market bouncing around and possible values going down a little bit because we're getting that steady income. Just another question here that I cut out a little bit. So Karen, can you hear me okay? Okay, so with dividend aristocrats, they have paid and raised their dividend for 25 consecutive years. None of them through at least 3 days ago had cut their dividends this year. So what we're really talking about there is making sure that we're buying good quality, top of the line type companies, type investments, that we're not speculating, but we're investing. We're buying really the highest quality investments we can that will pay us incomes, good times and bad. Because like the one chart that I went through, this is going to happen. The cause is going to be different, but it's going to happen several times during a 10, 20, 30-year retirement. That's just the way it works. And so we need to make sure that we're set up, that we're bulletproof, so to speak, to be able to get through those times. Hopefully that answers that. Other questions out there? And I think everyone's muted right now. So
yeah, I did. I remuted everybody. There we go. Does anybody have questions? So Rusty, one of the questions that I get is I have several people that they have asked me questions of, well, should I be investing more, or should I jump on the bandwagon and up my risk? Is this a better time to buy? Is this a better time to start going out and setting up retirement accounts and everything? What should I be doing?
I would say that, again, it depends on the individual situation. If someone is invested as near or in retirement, then I would say, rebalance to your plan. Don't go out and take a lot more risk. If someone is young and starting up, it's an absolutely excellent time to start investing because that person has a long time to let the market bounce around. I talked about the different types of recovery, whether that's a V-shaped recovery, U-shaped, or a W. If it happens to be a W and you take more risk right now, you chance losing more when the market drops back down, which sure could happen. And so we don't want to, take more risk than we can afford. During March, when the market was really tanking, I had kind of 3 types of clients. I had the clients that were calling up and saying, get me out of this market. This is horrible. This is never going to end. We're going to go to zero. The end of the world is coming. And I had the clients that were in the middle that said, this doesn't make me happy. I'm not comfortable, but I'm holding in there. I'm hanging in there, and you do what you need to do. And then I had the clients that were calling me wanting to buy. And the middle person I was great with. The other two, I was having to spend lots of energy talking them out of doing what they wanted to do. Because there's nothing wrong with buying while it's down, but I talk about dollar cost averaging, and I talk about baby steps. If anyone's seen the movie What About Bob, one of my favorites, take those baby steps. Don't jump all in, because it could keep going lower. It's kind of like trying to catch a falling knife. You're better off stepping back and letting it fall, and then trying to pick up the pieces a little bit. So again, for someone young, for someone that has extra cash that's not allocated as aggressively as what their plan might call for, absolutely put some money in, but again, do it in small increments. Don't jump all the way in here.
All right. Does anybody else have any questions for Rusty?
Oh, I think there was one more question that came through on the chat line.
Oh, sorry.
Dividend achiever
ahead,
versus
Rusty.
dividend aristocrat. And dividend achiever is, again, 10 consecutive years of paying and raising their dividend. Dividend aristocrat is 25 consecutive years of paying and raising their dividend. And while one hopefully is safer than another, again, the same diversification, all of those rules still apply. And we really do a deep dive if you're talking about, for example, energy right now. If anyone's filled up their car recently or listened to the news in terms of energy and oil prices and all of that, you definitely want quality when you're talking about certain areas of the market. So that's just one more indicator to make sure that a company is a high quality company.
So does anybody have any last questions? I'm gonna share Rusty's contact information again. So if you have any questions for Rusty, you can, maybe I'm gonna share. It may not let me. Let me see here.
Thanks, Rusty. Thanks, Karen.
Absolutely. So if anybody has any questions for Rusty, you can get in touch with him at 208-883-5396, or his email is rschatz@dadco.com. And definitely get in touch with him if you have any questions. Let's see here. Here, I can share screen this way. So there is Rusty's information. Definitely get in touch with him if you have any questions. But and if you have any questions, get in touch with me. I'm glad to get you connected to him or whatever you need, and we will try to help you through all of this. So Rusty, thank you so much for coming and visiting with us. We really appreciate it. This was all great information and so very helpful, so very positive, and that's what I really appreciate about all of this is that I think that we need more positive stuff, because there is so much doom and gloom out there that we need to know that this has happened. This is pretty historical, and so this happens a lot. So thank you guys so very much. We have one last class on Thursday, and then we'll be opening up some new classes in the month of May. So I'll be sending more things out for you on that. But thank you all so much for coming, and you have a lovely Tuesday afternoon.
Thank you, everyone.
Bye-bye.
Bye.